saying good evening to everyone. It's awesome to have everyone online, and I know Ryan's going to take us through a fantastic webinar tonight. So over to you, Ryan.
We're so excited to be doing the webinar this evening. We thought we'd speak at the same time. So it's great to have you all online this evening. We've got quite a panel on. We've got Andrew Rissik from Sable. We've got James Paynter, our RAND expert. We've got Scott Picken, CEO and founder of IPS and Wealth Migrate. And of course, we've got all of you, and we've got a fantastic turnout. It's our second biggest webinar in the history of IPS. And I can see why. You know, the rand and the currency at this point in time is something that's on the forefront of all South Africans' minds, and we're absolutely privileged to have the leading experts here within South Africa who actually deal with the currency on a day-to-day basis in different forms to give us not only the historical evidence as to why we are in this particular situation, but more importantly, where are we going to go in the future, and what can we do about it to make sure that we continue living a quality life for ourselves and also create wealth preservation and financial independence for our family and children moving forward. So just to make sure you can all hear us, please type in where you are actually dialing in from. What city are you dialing in from in the question box provided on the GoToWebinar control panel. That'll give us an opportunity to make sure that you can hear us loud and clear, and also to make sure that we can hear lots of people coming in from different areas. We've got London, Cape Town, Johannesburg, Knysna, Durban. We've got a few more from Worcester, Johannesburg, Kyalami, Abu Dhabi, Gabon, Port Elizabeth, Zimbabwe, Forex, gee whiz, Melkbos Strand. I'll come and visit you. I live down the road from you. Little Bruck River. Well, we're basically Heidelberg, ladies. Gee whiz. This is a fantastic webinar being represented by all of South Africa. So thank you, everybody. We can confirm that you can actually hear us and confirm that you are actually online and you can see us loud and clear. So without further ado, I'd actually like to just hand over because we've got so much to cover in a very short space of time. We're going to try and finish within an hour and 15, an hour or 30 minutes. But I will ask you that during the webinar, at any point, please type in any questions that you may have. You may have questions now. You may actually get questions as we go through the presentation as well. So at any point, please type in your questions in the questions box provided. I'll actually make a note of those questions, and we will then have an opportunity at the end to have our panel ask or answer some of these questions. So please be involved and please pay attention. So if I can just hand over to you, Scott. I know you've got some preliminary information you want to go through, and we'll get Scott Picken from IPS to kick off the presentation.
Cool. Well, thanks very much, Ryan, and awesome it's actually my first webinar for the year. I can't believe it in early February. But you know, when I was talking to Andrew just prior to you and Brendan doing that other webinar about 2-3 weeks ago, and I just kind of said to him, you know, what is kind of happening with the rand at the moment? Obviously, it's all over the place, and it's definitely the dinner table talk. And then I had a word with James, and tried to ask him what's going on, because it's very relevant to my own wealth and my own investment strategies. And that was really when the idea came up, and we said, well, I tell you what, why don't we put us all together so that we can try and give people clarity? Because the problem is that most people make mistakes when they don't have the right information, and they use their gut feel and their intuition and their banker's advice, and unfortunately all three of them don't have the experience, the knowledge to really be able to make the right decisions. So that's kind of the premise where we come from. And what I wanted to share with you, which I think is probably one of the most important things of last year, is that 2 years ago, all of my friends, we go away on an annual golf day, and they were asking me why this was 2012, and they're like, why are you investing in America? Why are you investing in Australia and London? And it's so much effort, and it's fair fun, goed na on your SCADA and all the challenges. And a year later, I came back and I did the calculation for 2013. The rand actually lost 24.08% against the US dollar in 2013, and I pretty much said to them, and unfortunately, it's not nice and people don't like it, but it's the truth. If you've got all your assets and your income in rand, unless you did better than 24.08%, well, you actually went backwards in 2013, and you could as well sat on the beach. And I put this picture in of Zuma because this was literally the picture when he was pleading to the global community to be nice to South Africa and be kind to the rand. And unfortunately, money markets don't work like that, as Andrew and James are going to point out tonight. We also, a lot of you would have seen this on different presentations, but I just wanted to highlight it. We did a lot of research for our book that we've launched with Clem Sunter, and a lot of people understand the consumer price index, and the thing with the consumer price index is obviously a basket of goods, and it's basically a class of whether the property or whether things are getting more expensive or not. And what we said was, that's all good and well in South Africa, but how does that impact me as a South African in terms of my global wealth? And so we basically created and patented the Global Wealth Index and trademarked it. And what we wanted to understand was, in terms of our economic freedom, so that we can make whatever decisions we want in our life, and how is our global wealth impacted. And the research we did last year was actually quite frightening. We took multiple countries, we took multiple currencies between the pound, the Aussie dollar, the US dollar. We took things like skiing holidays. We took private schools in Australia. We took Harvard, university education in America. We took immigrating, all the things that you don't necessarily want to do, but you certainly want to have the freedom so that we could calculate what happened. And over the last 30 years, the straight line graph is actually 77%. And the compound, people always say, well, let's get technical and get compounded. It's a scary number at 29.5%. It's decreased per year for the last 30 years. Now, these numbers are not nice. And when I first read them, I actually found them quite frightening. But I do let people know about them, and it is an entire chapter that we dedicated in the book. It's actually chapter 2 that James literally helped me write pretty much the entire chapter, because it shows how important this stuff is to your wealth and ultimately to your freedom. This graph is directly from James, and he's going to go into a lot more detail. But obviously the rand goes up and down. That's not a debate. The average since 1990 is about 5.6% depreciation, and actually over the last 30 years is actually over 6%. Now, that's the long-term trends, and again, we've got two experts that will go into it. But the impact that has on us as South Africans is absolutely dramatic. And at a basic, simple level, I had one lady say to me, but I can get a 15% return in South Africa. And I said, that's great. By comparison, you then need to look at a 9% return in the US based on a 30-year graph and the fact that it's changing by 6%. And that, if you want to compare an apple with an apple, it's absolutely fundamental. But my point tonight is not to be here and to kind of get into the rand, because that's what we've got two of the best leading people in South Africa. And what we wanted to do was to start off with Andrew. You should all be able to see. I just took a screenshot of Andrew's actual website in terms of his company. Now, Andrew's a very, very interesting fellow. I've known him for a long time. We've done a huge amount of work together. We pretty much exclusively put every single one of our clients through Sable, and we also put all our own money back and forth. And it's been an extremely good relationship for both our clients and for us, because they really are transparent. They know what they're doing. They're a big company, and I'll let him explain more about that, actually based out of the UK. And the most important thing for me is that this is what they specialize in. So in terms of getting your tax clearances and everything else, they do it every single week. Every single Thursday, they have a standing relationship with SARS to go and get tax clearances for the clients. Whereas the average guy wants to use his accountant, and he does 2 tax clearances in his whole life. But the reason we asked Andrew to be here tonight is that he literally moves massive amounts of money on a daily basis. And we wanted to kind of ask him what's happening now, kind of what has happened over the last 3 years, and why has it happened? Because he's current and he knows what's going on. So I'm going to change over in terms of the slides here and just bring up Andrew's slide so that he can actually go into it. But I think without further ado, I'd like to hand over to Andrew. And Andrew's just going to explain a little bit about who their group is so that you kind of understand their size and where, justify their experience. And then ultimately he can get into the detail of what we're all here to learn about tonight. So welcome, Andrew. It's fantastic to have you online.
Thanks very much, Scott, and welcome, ladies and gentlemen. It's quite strange for me. I can't hear any of you and I can't see you, but I can see the numbers on the screen. So I know there's a big audience. I'm not going to take too much time, just a little introduction. I'm the MD of our Forex business, part of the Sable group. Our company is based in London, And we basically provide personalized professional services to small and medium-sized businesses as well as private individuals with international interests. So anybody that you know who either trades cross-border or any private individuals living in one country who may have assets in another. And I think in a globalizing world, certainly in the South African context, that's a very big population. The company was founded in 1995, so we've been in business for almost 20 years, and initially started servicing the South African expat community in London. Our head office, as I say, is in London, and we've got a very big operation in Cape Town in South Africa, where I'm based. I'm definitely the luckiest member of the board of directors because I live in Cape Town, and I think I run the most exciting part of the company. We've also got an office in Melbourne in Australia, and we've got a small presence in Mauritius as well. So just a little bit about what we do as a group. Obviously, we've got our Forex business. We have a UK tax and accounting practice in the United Kingdom. Spur Group are one of our clients, a big South African business that's starting to grow quite aggressively in the UK. We have a visa and UK nationality practice. We specialize in British nationality. And then in the UK, we have a UK-based wealth management business which really targets British-based clients looking for wealth management. We currently employ just in excess of 200 staff in the 3 offices. So just going a little bit into the Forex service, I'd describe us as a low-cost, regulated exchange provider. Scott, you can actually flick to the next slide. Thanks.
Okay.
I think what's really important is we've been in business for a long time, but more importantly, we actually are regulated, registered, and authorized in all the jurisdictions that we operate. So in the South African context, we are FSB approved, FIC, which is the Financial Intelligence Center, and we're also approved by the South African Reserve Bank. And then we have the similar type of licenses in the UK and Australia. And we also currently, we've recently got a FinCEN license for the United States of America. And the key channels and markets that we operate in are the typical sort of first world markets. We, at this stage, tend to stay out of the low value, sort of higher risk areas because of money laundering concerns. And then, Scott, to the next slide. I think just to summarize, really what we try and do in the marketplace is to educate people that there are alternatives to moving money around the world rather than using your own bank. So as I've mentioned, we registered where we operate. We're very transparent and we're very competitive on price. So if you buy currency through us and we move it for you, you'll know exactly what you're going to get on the other side, and there'll be no surprises. Personal services is how we grow our business. We're not like a lot of other big institutions that have got huge marketing budgets, and so we rely on word of mouth, and that's how the business grows, and it's growing at a good rate. What really makes us quite unique is we've got a simple online system. So it's like an international online internet banking platform, which is secure, and all the cards are verified by Visa, and that results in really a very speedy settlement solution. So if you want to move money from England back to South Africa, instead of it taking 7 or 8 days if you do it through your bank, and sometimes even more, we guarantee 2 working days, and very often it's actually with the recipient the next day. Our staff are all highly skilled. That's all they do on a daily basis, and so they can really help you, and they're very knowledgeable about what they're talking about and all the different regulations under which the money has to move. As I said earlier, we've been in business for 20 years, and we turn over in excess of R1 billion a year, and that translates into about 12,000 transfers a month that we process in our office in Cape Town, and that services our global clientele. We've got about 40,000 customers, and yeah, as I said, we aim just to educate and help people find an alternative that's more efficient. So that's just a bit about us. Thank you.
And I think just to back up something that I think is very important, I use one of the local banks, one of the big 4 that everyone knows, and the guys were very kind of incompetent and always trying to chase me for, take the rate now or take it tomorrow. And I mean, literally in the volumes we're using, it can be 10, 20, 30,000 Rand if you get it wrong by like a couple of cents, And the beauty of working with Andrew's team is that, you're getting the best rate. So it's not a game. You don't have to worry about whether it's now or in 3 minutes' time. And also, on top of that, is exactly what you said in terms of the speediness, which is incredibly important when you, particularly in America, where things happen really quickly. And people lose deals if they don't understand that speediness. So that is fundamental. So listen, Andrew, thank you very much for the intro. I look forward to kind of getting into the nuts and bolts with you in the debate. The next person I want to hand over to is James, and I'm actually going to do a screen share with James so that he's actually got his own slides. Now, while I'm introducing James, and I'm just looking for him there he is. I think what's important with James is that James and I, again, have known each other for a long time. We've worked together for a long time. And James, if you can just click accept there, and it should come over to you in terms of the panelist. But I think what's most important with James is that if anyone wants to understand the accuracy of what James does, we've been doing webinars now. We did one in about November 2012. We did another one in January 2013. We did the extravaganza in March 2013, and we did another webinar in June 2013. And it's actually incredible how his forecasting and how accurate his forecasting's been. And if anyone disagrees or doubts that, go on YouTube, search for James Paynter, and watch the webinars I did with them a year ago. And, I mean, just to highlight what I'm talking about, in March, as an example, we had 202 people in the room. He told us that within 3 months, the Rand was on 888 that day. I'll never forget it. And he said, within 3 months, the Rand will be over 10 Rand to the dollar. And I said, with what probability? And he said, 90%. And literally, about 22 people took action. 180 said, yeah, and they had a whole lot of excuses. And within 8 weeks, the Rand went over 10 Rand to the dollar and has never recovered back below 10 Rand. And that's the importance of understanding what he does. And the only reason I'm giving him kind of that track record and that credibility is because I've seen it with my own eyes. And the people that don't listen to what he's saying get affected badly. So over to you, James, in terms of explaining a little bit about yourself and how you do it.
Thanks very much, Scott. And once again, I'm very pleased to be with you and now Andrew, and with all the rest of you too. I see we're still getting persons entering the room, which is good to see. Yeah, just a short intro. I'm not an economist at all. I've got a automotive mechanical engineering background and have been in management of offshore investments since 1993, and that's actually where I got into the handling of Forex and the interest in analyzing where the Rand is going. And when we had that huge move up to 1385 in 2001, and then the market came crashing down again down to 2005. That's really where we started asking the questions. Now, why is it doing this? Where's the Rand? Where should the Rand be fundamentally? And why are we seeing these big swings either way? And that's where I got into analyzing the Rand and started forecasting it in 2005, and have been doing it since for hundreds of clients in many countries, and being consulted by leading industrialists and financial institutions, as well as we do some articles in leading business magazines and periodicals. So that's my background. Scott, I don't know whether you wanted me to go into things from my point of view, or you...
No, very, very much so. So I think, look, James, in terms of your background, for me, your results speak for themselves. Your accuracy since 2005 has been over 80%. And again, for those people who doubt what I'm talking about, go and watch the webinars I recorded live with him, and literally watch what happened, what he said, and what transpired. I'm amazed by the accuracy. So what I really would like to kind of get from you is, obviously, Andrew is very much in the moment and can explain what is happening. You, on the other hand, are more about the future and forecasting. So I think what would be very valuable is if you could kind of explain kind of, how the forecasting works, what are the fundamentals, and most importantly, kind of what is the future looking like in terms of your eyes. So, if you could kind of take us through the fundamentals and how you do it,
Okay. Well, if you look at the 30-year was about almost a 35-year history of the rand. This is against the dollar. We can see how it has performed from here below 3 in 1990 up to where we are today, with these huge swings that we've seen 2001 down to 2005, up again, down again, and where we are today, back up again over 11. If we look at the rand, there are two drivers of the rand. The one is the fundamentals, and the fundamentals determine the long-term trend of the rand. And then you get the mass sentiment of persons actually trading the rand. Whoever they might be, everyone involved in the trading of the rand, you get the sentiment. And that is what determines the intermediate trends. When you say intermediate, they can be years long, as we've seen there with the green arrows. But if you just look at the fundamentals, and you showed that slide earlier, Scott, that if you look at the base fundamentals, the exchange rate is there as an adjusting gear in order for us to remain competitive. And that adjusting gear adjusts for changing productivity and a change in labor cost between us and our trading partners. Now, if we look at the history, how we performed, we've got a graph here on productivity, GDP per capita, with South Africa and blue and our trading partners in purple. And you can see there that from 1981, where we had 31% of our trading partners in terms of productivity, that dropped down to 10% in 2002. Since then, we've recovered, but we're still sitting at 19% of the productivity of our trading partners. So that's the first side. The second is our labor cost and how that is increased compared with our trading partners. And again, here you can see that that started a graph in 1981 that we were 37% of our trading partners. And 2011, which is the latest date that we've got hold of, for all our trading partners, we're sitting at 147%. So you can see, especially in the last 4 or 5 years, how our labor cost has increased while our trading partners have actually decreased. And because of that, you've got the long-term trend that the rand has needed to adjust by between 5 and 6% to remain competitive on a fundamental basis.
And I think what's quite important there, James, that I understood when I watched you do this the first time, is that the question is, are those fundamentals going to change? And my question to you is, do either of those major fundamentals look like they are either changing or reversing in the near future?
Well, I think you can answer that question just as well as I can, Scott. I mean, our labor our labour situation here has not got better. It's got worse. I mean, we got now the striking, platinum mines, minimum wages, and all that sort of thing. And yeah, productivity has picked up, but it's nowhere near where it was in the 1980s. So yeah, fundamentally, I don't see that those two base elements changing.
Okay.
Okay. So in reality, where we're sitting today, we actually, on average, has been 6.3%. Where we're sitting at 11 today, or 11.14 that was yesterday.
Since 1990.
Okay. Since 1990, yeah. So our wealth, your rand wealth, has eroded at 6.3% year on year since 1990. But just as you can see here, we've got a rand at fair value where we've got the hatched area between the blue and the red lines. And what you can see is that the rand has, we've seen big moves either way of fair value, which can't be put down to fundamentals. And that is where the real driver in the market comes into play. And why that is, if we just have a look at the next slide here, that if we break up the rand market, the players in the rand market, we've got $15 billion being traded every day against the rand. There's 2012 data that we've got. Of that 15 billion, only 6.1% relate to goods and services, which are the fundamentals. The balance is all speculative, investment-based and speculative, whether by non-residents or residents that are onshore or offshore. But as you can see there, the vast majority is non-residents, 64.1%. And you can see how that has increased manyfold since the mid-1990s. And that is the real driver of the market. So it is this speculative sentiment that isn't related to whether the cost of goods is a fair cost of goods or not. These guys are coming into this country based on what they can bring their funds in here at, what they can make while their funds are here, and when they get out. And that is why we have those huge swings in the rand, why we have had. So,
but I think that's very important for people to understand, because you've got the fundamentals and then you've got the sentiment. And even as South Africans, 64% of what you're talking about isn't even controlled by South Africans. And they literally are very fickle. They see one piece of bad news overseas and they get nervous and they just move their money. It's not a motor car factory where it's foreign direct investment and it's there, and to get rid of it takes a long time, whatever. It's literally in art. It's money markets being played with, basically. And people need to understand that, because that's why things can change so quickly in terms of what's happening. So I'm sorry to butt in, but what's really important is, you've explained the fundamentals, you've explained the sentiment, but what I'm more interested in, yes, I kind of know how a car drives, but to be honest, I don't really care how my car drives. I just want to be able to drive my car, and it helps me get from A to B. So what I'm more interested in is kind of, how do you tell us where we're going, and let's get into the detail.
Okay. Well, if we just go actually back to this chart here, if we look at that rand, the rand chart, most persons, when they look at that, think that that is a chart of financial data. So the vast majority of people think that, but it's not. It's actually a chart of the mass sentiment, the mass human emotion in the rand market at any point in time. So whatever information there is that's affecting the rand is actually being filtered through this millions of persons trading the rand, and it's their decision whether to buy or sell or not to do anything that actually creates these patterns. So if we look at
Muted.
Sorry, Scott, is that better?
Unmuted.
Yeah, we're good to go, James. Sorry about that.
Okay. Now why we can actually forecast the rand, therefore, is that those emotions, because we are humans, we tend to make the same decisions in the same circumstances. So those patterns that we see repeat themselves in smaller and larger degrees. And because of that, we actually have some predictability about the market. One, the market is irrational. Persons often don't make rational decisions, but because it's emotional and because our emotions recur, there is predictability. And you'd like this, Scott, but we liken it to weather patterns. If we look at Hurricane Sandy in 2012, and yet Hurricane Central was able to warn the US citizens days ahead of time as to where that hurricane was going to make landfall, what wind speeds were expected, the surge, the path of it. And the only reason they could do that is because they'd analyzed previous weather patterns and then taken the current existing set of data and said, this happened in the past, so we can expect something similar to happen in future.
And I think James, the most important thing for me there was that, I always say, I'd listened to you talk lots and I'd read all your reports, and I really kind of struggled to understand why your accuracy was so good. But when you kind of equated it to the weatherman, we all know the weatherman's not perfect, but I tell you what, he's got a damn sight better idea of whether it's going to rain tomorrow or be sunny. And based on that, I decide whether to have a braai or not, and that's what really made a lot of sense to me in terms of understanding what you do and how you get your accuracy.
Yes, and also, I'm hopeless at telling what the weather's going to be like, but there are experts that have analyzed those patterns, and especially with increased technology, they're actually able to provide more and more accurate data going forward. So when we look at, in essence, our technology is pattern matching technology. We look at a past set of data and see where that find a best fit to the current pattern, and it then gives us where the current pattern of emotion is likely to play out in terms of in time and price. So just through analyzing those past patterns, we can then have some probable outcome for the current market.
And I think what we're going to do, James, is what I'd like to do is obviously we wanted to set the tone so people understand kind of Andrew and where his background was, and you and your background. And I think what's quite important, now is that we, get to the point where we actually kind of get into the debate. I just wanted to share with you two screens from our perspective in terms of what it is that we do. and then ultimately, we can get to the questions that everyone's really interested to hear. And I guarantee you, everyone's interested to know from you, based on your results in the past, is kind of where's the rand going and why is it going to happen? And we'll get into that, because I think that's critical in terms of the big picture. So if you don't mind, is there something else that, or did you mind if I change back to myself as presenter?
No, absolutely.
Okay, perfect. So let me just find my name there. Boom, boom, boom. Where is Scott? Scott Organizer. Okay.
Did you want to? We've got quite a few questions, Scott. Did we want to cover a couple of questions, or did we still want to have James carry on with his forecast at this stage?
Well, Ryan, what I wanted to do actually was just quickly from our perspective in terms of where James is and what he's been talking about. I just wanted to kind of just explain a little bit about myself and IPS and kind of how we fit in between the two of them, and then really get into the questions, because that's why we're here tonight. That's the nitty-gritty. And I think what I wanted to back up is that you should all be able to see my screen. We've always had a philosophy of only partnering with the best. Ryan always talks about the inner circle and how important it is. And, if you're going to deal with an analyst or an expert, you can either go to the best in the country or you can deal with the riffraff at middle management. We've never done that. And that's why we're so privileged to have Andrew and James online. I also think it's important that both of them contributed to the book, which we're very proud of, that we launched at the end of last year and is literally out now. And that's Property Going Global. It was based on a lot of Clem Sunter's methodologies. Clem Sunter's actually written the foreword and endorsed the model and done webinars with us to prove that. And I think what's also critical is that, James wrote the entire chapter in chapter 2. So if you want to read 40 or 50 pages, I don't know if it's exactly that long, maybe 30 or 40 pages, whatever it is, but with all the graphs and literally going into detail for those kind of, what are they, Ryan? B-type personalities, the guys that want all the detail, then it's there. It's chapter 2 and people can get it. And we'll give, if people hang around online tonight, we'll also, show them how they can get access to a free copy of that book. I think for some people who don't know who we are from an IPS perspective, we've only ever done international property investment. We've helped over 2,000 people invest internationally to a value of over 1.7 billion. And I think what's important is we've got offices in South Africa, Australia, the UK, and the USA. And we're not fly-by-night salesmen that turn up with a suitcase and try and peddle you a product. We spend millions on research, all the amount of time and energy. I think in the US now, we're well over 2.7 million rand we've invested just in personal money, flying there, paying for flights, accommodation. I know Andrew came over with us in October last year, and I'm sure you'll attest that it's not cheap. And, I think one of the things that differentiates us is really the best of breed partners and the fact that we have a sophisticated IT platform in terms of how we work. And then really from our perspective, it's all about private banking. It's about providing people with an end-to-end solution. So it's not just about buying the property. It's about dealing with Andrew so that he can actually help you move the money. It's about understanding from James in terms of where the rand is going and what the possibilities are. And then multiple other experts and people who specialize in it, from the lawyers to the management agents. It's an end-to-end solution. And for those of you interested, we've got the qualifications. I don't think it counts for a huge amount, but we were invited, the first one, into the AIPP, which stands for the Association of International Property Professionals. We also won the award in 2008 for being the most professional company in Africa, and also CRS, which is the Certified Residential Specialist, which is the highest qualification you can get worldwide, based out of America. But for me, that's just kind of giving a roundup of kind of who we are so that you understand, all three of us, and kind of where we're bringing stuff from. I think, Ryan, the reason most people are online tonight is to understand the major questions and kind of want to know, what's happening. So I'll hand over to you and you can go through the questions.
Yeah, sure. So just at this stage, James, I believe you've got some information in regards to where the rand's moving in the short, medium, and long term. And I'm not sure if Scott, are you going to be handing over to James on the slide aspect?
What I'd suggest is it's probably easier. I've actually got James's website open. So what might be easier is just to go direct to. You should be able to see my screen now. And we've actually got his tool that I've subscribed to and that I check regularly. not only for myself, but when trying to understand where the market's going for when our clients are trying to make decisions and when we're moving big amounts of money with Wealth Migrate. So yeah, I think the important thing, and James, I mean, this is really your level of expertise, but I think the important thing is that you always give us a short-term outlook in terms of the next few days. And for me as a property investor, it's fairly irrelevant because I'm investing with a 5-year view. But for those people who are interested, if I look at the rand dollar, and just for the interest, we're not going to go into it tonight. But I mean, people can, if they want to. You've got the euro rand, you've got the pound rand. It's not. But we're just going to use the USD as a standard one tonight. But just tell us a little bit, James, in terms of the short term, and then what I think is more important is spending time on the next few weeks, the next few months, and the next few years. But just give us a bit of an indication in terms of what we're looking at here.
Yeah, short term, the next few days, the next few weeks. Overall, we're looking for a possible correction down, let's say downward correction, before we have a final move up to new highs. So that's what the patterns are showing at the moment. And if we go then down to the next few months, the third chart down, that once that pattern is complete, we can just go down there, Scott.
Yeah, I'm on the next few months, eh? Okay, you should be able to see it now.
Yeah, okay, yeah. That you'll see we've got a target area there of 1120 to 1195, and once that pattern is complete, it completes a pattern that started back in April 2011. So in terms of sentiment, I think we can see it all around. We're reaching an extreme of negative sentiment against the rand, and when that happens, effectively everyone has taken action. Everyone has taken action that's going to push the rand any weaker, and once we get to that point, we will then see a correction back down. The actual timing of that is perhaps a bit, it depends how the patterns actually play out, but we're looking for a move probably back down to the 1050 area as a minimum, possibly into the 1050 to 10 area, and with a small chance, probably about a 25% chance to move down to 950. But if we go down to the long term.
Sorry, just quickly, just to point out here, and it's something James has been doing in the last year or so, and he didn't used to do it, and that's why I always used to ask about the probability, is that it's very important, if you go to a doctor and they say, look, you've got, X disease, and there's a 70% probability of survival, it's a very important number to know. And so those probabilities are exactly what you're talking about here, and kind of which line it's going to go. And for me, it helps me make my decisions, because based on what Clem Sunter says in terms of the scenarios and the chances of the scenarios transpiring and your probabilities, it allows us to make mathematical decisions. So I just wanted to kind of highlight that before you go into the next few years.
Okay, yeah, that is very important. This long-term chart, I'd say, is probably the most important of all the charts, because this goes right back to mid-1970s, and we've had a 30. If you look at the graph, we had a 30-year trend, so a bull trend of the dollar bull trend up until 2001, and since that time we've been in a correction down down to 2005, up to 2008, and down to 2011. And what the patterns are telling us is that we are now in a new long-term uptrend. And if you look at that, we've got the trend line support and resistance. If you take a line from the top of 2001 to 2008, you can see we've broken above that resistance line in the past month, and that is confirmation to us that we are now in a new long-term uptrend. But before we head up into that target area, which we're looking at 14 to 21, we should see a move back down to test that same line, which was resistance. It's been a ceiling, but now is support, like a floor. And then there is a small chance we've got there, 20% probability that if we break below that line, that we could then head back down to the bottom trend line, which comes in at around about 8 or so, before we head up to that 14 to 21 level.
And I think what's really important here, just to show the probabilities, is that, what you're saying is that kind of best case scenario, we get back to 10, 10 here, and then going back up to 14, and you're given an 80% probability of that. The other one is where we go a little bit lower to the bottom trend line, and then we still go back to 14. So there's no debate whether we're going to 14. It's just whether it's 3 or 2 or 3 or 4 years. And in terms of that recovery, also kind of how deep it goes. But I come back to it, and fairly most people with common sense, that if you're a betting man and you're told a kind of 80% probability, it's a big risk to take based on the 20%, considering that it's not even that good and it's still going in the same direction.
Correct.
James, can I ask you a question at this stage? It's one that I was actually in a meeting today, and I can see a few people have asked me here on the question box provided, and thanks to those of you who've actually participated. Those of you who haven't, please feel free to ask any questions that you may have. I'm sure you've got lots. But just on this particular point, you said there might be a small correction to that line that's now a support line that was a resistance, and it might go to about 10, 10.5, and maybe even 9, a 25% probability of 9. But the question that I'm getting, particularly with more experienced human beings, people who aren't in their 30s like myself and Scott and everyone else, they're saying, it's going to be exactly like when the Rand hit 20 Rand to the pound, and it's going to recover. It's going to make a massive recovery to 10 Rand 61 like it did. So basically, you're saying that's the probability of that happening is almost impossible. Is that correct?
Yes. We're in a different market.
Yeah.
Than when we were at in 2001 and 2008. There the market was in 2001 we had reached the end of a 30-year trend. In 2008 it was the end of a correction within a sideways correction. But now we are in a new trend up. So the chances of that happening is close to 0.
Okay. Thanks for clarifying that. Yeah, thanks. Is there anything else you wanted to go through in terms of the forecast there? And any other questions from your side, Scott?
No, I think the most important thing is that as an investor, and someone, particularly if you're investing offshore and particularly if you're investing in property, you should be taking a 5-year view. And if you take a 5-year view, there's no chance, according to what James is showing us, that we're not going between 14 to 21 to the US dollar. And so a lot of people get quite caught up in the sentiment. There was a lady who I know well, and we just went to America, and she was really caught up in, it was 11:10, and she thought if she waited a day, it would be 11:16, and her money was actually sitting with Andrew, and she didn't know what to do, and should she move her money? And I said to her, I've got so many examples of people that sat when it was 870, and do I bother about, it's gone to 880, should I do anything? And I was like, guys, this is long term, and I can guarantee there's quite a few of them online tonight that they are so happy that they just did something, when it's sitting at 11, if it's 10, 11, doesn't make any difference. And the point being is that, there's also a hell of a lot of people that used that as an excuse and did nothing. And I just wanted to kind of reiterate, between the medium term and what James is saying and how important the long term is in terms of the bigger picture. But yeah, so that's all from my side, Ryan.
Excellent, great. Good. Well, again, everybody, feel free to ask any more questions. These types of analysis can get incredibly technical. Remember, we held a webinar, I think it was close to 2 hours, going into the real fundamentals of this. If you are interested in finding out a lot more information about the technicality, and I can see a lot of you are very astute investors online, then please type James into the question box provided, and we can send you a link to James's analysis, and you can indeed subscribe to his more thorough analysis about what's happening, where it's going. So if you can all type in James into the question box provided, and we'll send you a link to James's analysis and website, we'll gladly do that, and just to get you guys involved there. And I think this is a good point then, Andrew, to bring you online, because we were just chatting about this yesterday in preparation for this particular webinar, and you actually raised a point about the fact that we're in a situation around the perfect storm with relation to the Rand. Would you mind just taking a moment to explain a bit about that while we field some other questions in the meantime?
Yeah, thanks, Ryan. Yeah, James, very, very interesting. I've done a sort of a slightly more man in the street look back at the Rand, which I think I'd like to just share with you all before I answer the question about the perfect storm, because I think it'll drive the point home a little bit better. So James has been talking about since 1980 up to 2014, and that's in essence a little bit of history on the Rand. In 1979, it was when we essentially pegged ourselves to the dollar, and between 79 and 85, the Rand was pegging. We were tracking the pound. So if you looked at whatever the British pound was doing against the dollar, the Rand was basically tagging along. And that was because I think historically we had a very strong trading relationship with the Brits. And then in 1985, the foreign debt crisis set the Rand on a great downward trend with the dollar. And after 1994, when the new government came in, and that was really the key point where you start seeing a lot of foreign sort of speculative capital coming into the market. We still had the dual exchange rate system, and I think a lot of you will remember we had the financial and the commercial Rand. And the financial Rand was essentially there to protect our foreign reserves from politically motivated capital flight. And it was a product that was available to foreigners, which was created in the 60s, but really became quite prevalent in the 80s and the 90s. Now that was only abolished a year after the new government came into power. And that was the first time that South Africa, in sort of recent history, started to trade its unified currency on international markets. And that was a big vote of confidence, really, in South Africa. But with that, it brought this hugely speculative swings. And these can have marked effects on us. So, again, 1996, I don't know if you remember, Nelson Mandela wasn't very well in the early part of the year, and we saw quite a big slide, 16%, when it went from 3.70 to 4.30, and everyone thought, it was going off a cliff. I mean, that's an amazing slide, really. But I mean, 4.30 compared to today. Anyway, 96 until 2001, where we peaked at 13.85, close on 14. And then suddenly things started looking good again, and it was, the foreigners discovered the country. It was cheap for tourism. Tourism was becoming a great export. Our property market was discovered by foreign buyers, and so we were on a great positive trend. The global financial crisis tripped us up a bit, but we were hosting the World Cup in 2010, and in 2010 the Reserve Bank made some huge relaxations on exchange control, which I think created a lot of positive sentiment within the country, because everybody who was trying to drag money out suddenly realized, well, there's no real urgency. But lo and behold, as usual, it carried on the trend. And in 2011, we all had a big wake-up call. And everyone thought the rand would strengthen again. That was in August 2011. We had a big slide. And really since then, with a lot of the internal political sort of bantering that's been going on, 2012 we saw Julius Malema making a lot of noise, the ANC with the Mangaung conference. So we broke into some pretty poor territory again. And really since then, the three markets that support the rand are export markets, which are the mining sector, agriculture, and automotive manufacturing, have been targeted quite aggressively by trade unions and other political activists. So that's just a little bit of background, and what we're seeing now on a daily basis, and we deal with a lot of fairly sophisticated clients, is that wealthy taxpayers in South Africa have realized that we're on a slippery slope. We've got a widening trade deficit. Our current account deficit's not good. We've got a government that everybody's losing faith in. They're fairly corrupt, and they are going to be looking for tax revenues to service this ever-increasing deficit, that they're spending money to try and lure uneducated voters to keep them in power. And what that means is basically, it doesn't matter how strong your rand is, how much money you earn. I think we're just going to become more and more taxed here. So we've seen a really big outflow of very wealthy families, what we call the ultra-high net worths. These are people worth 100 million and over. I mean, the Oppenheimers have sold out. A lot of the big industrialists have already moved their money. So that's just a slightly more man-in-the-street picture, and those trends follow exactly the technicalities that James was talking about. So where we are today, and the quiet storm has really been happening since the end of last year, and it comes down to 5 or 6 key areas that you should always look at that affect the rand. Imports. We buy most stuff that the modern day consumer and anybody who watches television, we buy imported products, and typically people borrow money to buy those products. So therein lies a big problem. Our export markets are under pressure. The rand weakening obviously makes our exports quite attractive at the moment, but if you think of an apple farmer, if the rand goes from 7 rand to $1 to 12 rand to $1, people don't just suddenly start buying apples again because they've established relationships with other apple suppliers globally. So we will see an increase in exports in the sort of medium to long term, but it's not like the markets just turn on. Another factor that I think people underestimate a lot is that
Ek het mense wat saam met ons werk in Amerika, Australië en Engeland.
Scott? Is that computer for you, Andrew? And it should be muted in a second. There you go for it.
Thank you. Sorry, a lot of exporters nowadays no longer need to convert their. So if somebody invoices in dollars and their offshore customer pays them in US dollars, they can actually hold the currency for as long as they like before they convert it to rands. So what you're finding more and more is that people who trade internationally are actually holding hard currency. So again, that just keeps the demand on the rand low. And a lot of exporters are also not investing in growing their businesses because of political uncertainty. And again, it's around those strikes and a lot of militant behavior in our export markets. Another thing that James didn't really mention, but we're an emerging market currency, so we also subject to all the forces that knock us about. And there's a little crisis going on at the moment with all the emerging markets. I mean, Turkey raised their interest rates. They doubled their interest rate a couple of weeks ago. We've just had a 0.5% increase. And we're also a commodity currency because we're quite a big commodity-based economy. So at the moment, the global slowdown in China's growth is having a negative impact. And then, of course, James mentioned the money market. I think that is in a way, a good thing that's happened, that people can invest in our markets, but at the same time, it is crazy when a lot of retail investors are moving their money out now and the institutions haven't even started. That creates those major swings. But what you'll find is when it gets so weak, people will start entering the market again. So the long-term trend will normalize. But so when you refer to the perfect storm, I think it's very difficult to argue that we're in a very vulnerable position at the moment. So there may be a short-term correction because we've had quite a big slide in the last few months, but long-term, I think there's got to be a lot of structural change in the South African economy before we see the long-term trend turn. And that's, I think that sums it up.
Excellent. That's great. Thanks. Yeah, that's fantastic. Well, you certainly piqued some great interest there, Andrew, with all the questions we're getting. I think we could do like a 3-day webinar if we had to answer all the questions. Yeah. So there's a couple of questions that relate to a similar theme, and I'm going to summarize it for you here. And it's all around the fact that you obviously deal with all sorts of currencies, on a daily basis, but also historically. So a few people are curious, what are some of the best currencies to invest in, and maybe, what are people investing in at the moment, and what have people been doing historically? And if you can remember all those questions, maybe give us a bit of a motivation as to why that's the case as well.
Look, I think there are two things. I mean, you're talking about investing in a currency or investing in an asset in a market that's got a different currency. I think they're two different things. Strictly just investing in currency, if you look historically, all the major currencies have appreciated fairly similarly against the rand over the last, say, 20 years. I think the ones that stick out a lot are the Swiss franc, and that's really driven by a lot of Swiss internal policy that's made that a very attractive safe haven currency. And another one that's been exceptionally good against the rand has been the Australian dollar, and that's also been driven by the fact that Australia is really sitting right in the Asian markets of the world. They've got a very strong commodity-based economy, and they benefited a lot from their trade into China and the Middle East and the East, East Asia. So that's history. If you're looking to invest in any particular currency going forward, I can't really advise on that, but I would say that if you take a basket of major currencies and look at getting some sort of exposure, I think that that's a good approach to take. But then there's another approach, and if you're looking at maybe making, for instance, a property investment in offshore property, what you need to do is to try and understand the fundamentals of that particular market that you're investing in. So, just because the pound's always been a safe haven doesn't mean London's a great investment now, because London's extremely expensive, and you might be getting a rand hedge and safe shelter, but it could actually be quite a tough investment. Whereas if you go to other first world economies where the property markets are very discounted at the moment, for instance, parts of the US, there's some very good property deals. So I think the answer to that part of the question is make sure as a rand investor that's looking offshore that you make a good investment in that particular environment. So if you're buying a property in Orlando, make sure that if an American who lives in Orlando was buying it, it would be a good investment for him, because then it's going to be a good long-term investment. If it's a bad investment for an American, it's going to be a bad investment for you. So I think that you've got to drill a little bit deeper. I hope that answers the question.
Absolutely. And you actually, we've got a question here specifically
about... Ryan, just before we move on there, I think that's, what Andrew said is so important. You and I have both invested a lot in UK property. And to be fair, I haven't sold my UK properties because they're good yielding properties because I bought them many years ago. But right now, I can't see the point of buying properties that are at the highest value they've ever been. The last 6 months, they've continually gone to the highest values they've ever been. And whenever you're buying something at the top of the market, your risk is that much more. And obviously, I'm talking from a property perspective, not a currency perspective. But I'm just kind of reiterating what Andrew's saying, and one of the reasons why I'm personally not investing in London at the moment. So, yeah, sorry, back to you.
I mean, that's 100%. And you know, without giving all our brief stories, you know, I've been investing in the UK for 8 years before I moved back to South Africa, and hadn't bought something for nearly 2 to 3 years because you just couldn't get the deals, you couldn't get the yields, and and it was difficult to get finance, to be quite frank. So just on that similar theme there, Andrew, quite a few questions about some opportunities versus in the emerging markets versus benefits of first world currency. That seems to be quite a big theme as well in some of the questions that we're getting. Can you make a few comments about the risks or the benefits of investing in those particular markets?
Well, I think that the emerging markets have seen a run on them recently because, for two reasons. The Americans and the Europeans, to an extent, are starting to make a few noises about slowing down the quantitative easing, and that's, in layman's terms, they're printing money just to try and keep the liquidity in their markets going. So by talking about slowing down the quantitative easing, everybody's suddenly running and trying to get back into the hard currency. So there's quite a lot of demand for dollars at the moment, and that's putting pressure on a lot of the emerging market currencies. So take the Rand, for instance. The reason why a lot of people will invest into our money market is because our interest rate differential relative to their hard currency is quite high. So they could be earning close to a double-digit interest figure where they're earning basically nothing on their cash in their countries. But there comes a point where the currency risk becomes problematic for them, and that is basically sentiment-driven and very unpredictable. So the minute there's a slight panic, then the guys start moving the money out, and I think that's what's happening. So again, it goes down to when you're investing in foreign countries, you should really try and understand the fundamentals, because if you're taking a long-term view, maybe the Turkish lira has had quite a devaluation in the last couple of months, but maybe the fundamentals in Turkey are good. I don't know. I'm not a Turkish specialist. But it again goes down to my point of look at the underlying investment, not just the currency, and understand that currency trend against the majors.
And I think to add to that as well, you know, and again, sorry, I'm coming from a property perspective here.
Yeah,
but, sorry, Ryan, just quickly, but you know, I believe in South Africa. As a South African, we understand the market, we understand the risks better, we've got better networks and relationships. If you want to invest in an emerging market, well, invest in your back doorstep. It makes a lot more sense. You know, I've never understood why you would jump out of the frying pan into the fire. You know, take your money out of South Africa and invest in Zimbabwe or Cyprus or, you know, possibly you mentioned Turkey. You know, other emerging markets that are equally susceptible to the swings, you know, the ups and downs and the roundabouts that South Africa is. And that's one of the reasons why fundamentally, you know, I like to create my wealth locally, but ultimately I like to protect and invest my wealth in first world assets with first world incomes that's a lot more sustainable. And that's why the balance of the two, both from a currency and from an asset, you know, class that I choose to invest in, is kind of very kind of black and white in terms of investing in first world countries versus other emerging markets.
Yep. I agree. I mean, if you're wanting to dive, if you live in South Africa and this is where a lot of your wealth sits, then, you know, I would say that you should be looking at a harder currency. If you're only looking at one, if you're looking at a spread, go for 2 or 3 hard currencies, and then maybe look at some other emerging market investments.
Fantastic. So let's just do a poll here. Actually, we've got a poll lined up for everybody on the webinar. I'm just curious to know, for those of you who are actually on the webinar, how long have you actually been listening to webinars hosted by our IPS? So I'm just going to do a poll here for a few seconds. I won't keep it up for long. And Scott, if you could maybe just look at some of the questions there. I can see there's a question about QE and debt. Maybe you can just get clarity on what that is, and when we come back from these polls, you can ask those questions. I know we were discussing it earlier. So a lot of people are voting here. Thank you very much. Would appreciate your participation in this particular poll. It always gives us feedback as to how good our webinars are and how we can improve. And I'll close this particular poll in 3, 2, 1 seconds. Fantastic. Thanks everybody for participating in this particular poll. I'm also going to then just ask you another question. Obviously, we're looking at opportunities to invest and reasons and motivations to invest in different markets and offshore markets. When are you likely to invest? So it doesn't matter what the opportunity is. When are you likely to invest any money? Is it going to be 0 to 3 months? Is it going to be 3 to 6 months, 6 to 12 months? Or maybe you're unsure. Maybe you're still going about finding out details, finding out opportunities, and maybe you're not likely to invest because you've got capital restraints, or maybe you actually have some great opportunities going. So thanks for everyone participating in that, and I'll close that poll in 5, 4. It's amazing how the attendance increases when I do the countdown. 5, 4, 3, 2, and 1. Fantastic. So very even spread there across the investment time frames. And just so that we get an idea, if you don't mind answering this last poll before we go back to Scott and some other questions. And again, thanks for all your questions, everybody. What sort of level of capital are you looking to invest? And this is important for us from IPS perspective, and also I'm sure from Andrew's perspective, to understand, what is it what type of money are people looking to move, either offshore or maybe bringing it in back to South Africa. I don't know why you do that. And it's always great for us to understand how we can go about helping people at certain levels and designing products and services that actually suit your requirements. So if you can just please take a moment and complete that particular poll as well. It's a fantastic amount of people. Again, quite an even spread across that different range, and I'll be closing that poll in 5. Watch the attendance increase there, guys. 4, 3, 2, and 1. So thank you, everybody, for participating in that poll. It's always good to get that research because we want to make sure that these webinars are, good use of your time as well. So did you manage to get any more questions there, Scott?
Yeah, I think one of the questions that comes up a lot, and to be honest, I'm fascinated by the question myself, is quantitative easing is obviously kind of happening, and Andrew did refer to it, but why is the rand susceptible to kind of US policy and quantitative easing? Feels a bit like we're a cork on top of the ocean, but what do we need to be aware of? Because it is starting to happen, and why does it affect the rand and not necessarily the dollar?
Well, the interesting thing is that in the last few years, when the European monetary crisis happened, the rand wobbled, and it's just we linked to the euro. Well, we also seem to be linked to the dollar. I just think that if there's anything funny that happens in these sort of hard currency markets, it has a hard effect on us. So very simply put, what happens when quantitative easing happens? Let's talk about America specifically. After the global financial crisis, the banking sector ran out of money. There was a run on the banks, and basically the Fed had to step in and do something. And they didn't do it quick enough because there was a couple of failed banks. But what they started doing was they started printing money electronically, in inverted commas, and they started buying their own debt back. That's a crazy kind of concept, but they started guaranteeing their own debt to themselves. So you can work that one out. I don't know how we could get that right between ourselves and our neighbors, but what they basically did was they put liquidity into the market to try and ensure that the housing market didn't collapse further than it did, and they had to also save the banking sector. And what we're seeing now, obviously, is in any situation where you print money, and Zimbabwe is a classic case in point, is that it devalues the currency, because what it does is you put more supply in, and so the value of it comes down relative to other currencies. But I think America is so big, and the dollar as sort of global unit of currency, it doesn't matter how much I think they've printed close on $3 trillion to date. They were doing $85 billion per month, and they've scaled that back now. It still hasn't really had a majorly negative effect on the value of the dollar. But the interesting thing is they can't stop it overnight, because if they do, the dollar is going to increase dramatically, and that's going to cause all sorts of problems for America, because if the dollar strengthens too quickly, again, their exports and their manufacturing exports are going to become expensive, and they're going to go into a negative cycle and undo a lot of the good they've done. So I think what we're going to see is they're going to slowly, if you could imagine, it's a bit like a patient in an advanced recovery, the American economy, and quantitative easing is the life support system. So you don't want to take it away too quickly in case the patient falls over and hurts himself. It's a little bit like a youngster learning to swim or ride. At some stage, you've got to let go, and no doubt the child's going to fall off their bicycle, graze their knee, and I think that we've still got a little bit of that coming. I think there are going to be some more debt problems, and there are going to be those kind of up and down reactions. But I think long term, the Americans and the Europeans hopefully are educated, intelligent enough to actually change their behavior and take their economies in the medium to long term off these life support systems. And as long as that happens, it's going to be painful for us.
What about the other scenario, Andrew? It's one that a lot of people are asking. It's one that a lot of people say, keeps them from doing stuff, and that's the kind of the debt. Whether it's the actual debt we know about, whatever it is, 16, 17, 18 trillion, or even the kind of the social security investment and the stuff kind of, that people don't know about, and the unsecuritized debt they say, could be running as high as kind of $120 trillion. What impact would that have in terms of, I don't know, some sort of American default or currency collapse, or the kind of the Armageddon? But obviously, everyone has debt, but America kind of seems to be more casual about it than everyone else. What are the risks in terms of that?
It's a difficult question, and I think that if you think like we do, we were sort of taught, buy stuff that you can afford, or if you're going to take debt, make sure that you can service the debt and preferably use it to finance an asset that appreciates. Well, Western governments are not doing that. They are borrowing money to consume, which is very concerning. I don't know who should be more worried, the economy that owes the money or the economy that has owed the money. If I was the Chinese, I would be quite concerned, because I don't know if America can pay the money back. So it's happened historically in the past where the Americans have essentially written debt off. It wasn't that long ago. I think it was in the early part of the 19th century. I think they wiped the French out for a while. It's been done before. Quite how it's going to play out, I don't know. But if the Americans do default, it's going to have a massive impact on the world, and particularly Africa, where a lot of the economies are cash dollar based. And if the dollar fails, Africa fails. South Africa is going to get clobbered. So I think hopefully people will change their behavior, and we can trade our way out of it. I would put more faith in the Americans of being able to do that than economies that have uneducated people who expect handouts. Crises cause humans to change their behavior, and I think we are going to see some behavior changes in the future. But if you buy a dollar-based house, it's bricks and mortar, and you go into a hyperinflation scenario in America, that house is just going to become a lot more valuable in dollar terms, although the dollar may devalue. It's still going to be better than owning a US government bond. So I think that if you're going to be investing in everyone's very negative about investing in Europe, for instance, but if you buy bricks and mortar, at the end of the day, if it comes down to that, I'd rather own a hard asset in a first world economy than own, government bonds. That's where I would steer clear of.
And I think something that's also important there, Andrew, Egbert was asking me about, just as an example, Nigeria. The legal system also plays a huge, huge role. And people, don't take that into account as much as they should, And, in those type of chaotic times, you need the legal system to be behind you to protect your asset and to protect the income of your asset. And, again, that's one of the reasons that we focus on first world currencies, because our assets are protected. We get very used to what transpires in South Africa, and to be fair, it's even worse in the rest of Africa and other emerging markets. But it's not the way that it's done in first world countries, and I think that's critically important to understand in the long term.
Yeah, I think if a major currency wipeout comes out, you never know what's going to happen. But it's again sort of choosing the best of a bad bunch. And I think we all love, those of us, there are a lot of people, on the seminar tonight who don't live in South Africa, but have got strong ties here, and we all want to live here. But I think it's just sensible to hedge. And I mean, I remember when I moved back from the UK 10 years ago, when everyone was dooming and glooming about September the 11th and this, the whole sort of rise of Islam and whatever. I mean, who would have ever thought that South Africa would suddenly become such an attractive place? Because before that, we'd had a sort of a 8 or 9 year pretty negative run. So I think a lot of the movement that we see is really about relative action that's happening on either side of any particular currency pair. So at the moment, the pound is strengthening a lot against the rand. It's not necessarily, the rand has devalued more against the pound than it has against the dollar in the last few weeks. So that's because, there's been positive things happening in England relative to America in the short term. But, so again, it's difficult. But just go where you understand, where you're comfortable, and hedge.
And I think that brings up a point that Scott and I always talk about, and that is that, we invested in the UK and we bought when the timing was right. And one of those principles in property is you make your money when you buy. And although some of my properties in the UK are actually equity neutral, I'm earning £300, £400, £500, £600 a month income per property. And so I don't really care what the market does. Because my tenants have been well qualified and they keep paying the rent, and I've got good financing in there. So I'm not really too fussed about the market. I know that the legislation there supports me as well, not as great as the American market does, but those properties keep paying money into my bank every account. So Scott, I'm just conscious of time. Would you, while I just scan through some more questions, take a few moments to share with us a bit about what we're actually doing in America and investing-wise, and also how people can get involved. I do want to make one quick comment, actually. I can see some of you are saying your questions aren't being asked. I do want to point out that we've got over 350 people registered for this webinar. We'd love to answer every single person's question, and maybe we should do that in your next book, Scott. We can get Andrew, James, and yourself together to write a book. Because we've got enough questions there to write a manual. In an ideal scenario, we'd love to answer all your questions, and if we haven't this evening, we do apologize. We are able to actually give you investment consultations, the IPS team. So if you are interested in having a consultation where one of our asset managers call you to discuss how you could potentially invest your wealth here in South Africa, or perhaps you've got funds abroad, then please type in consultation, and we can actually get in contact with you and have that consultation with you, and perhaps answer those questions that we didn't have the time to answer this evening. So, Scott, if you wouldn't mind just taking us through some opportunities that we've got, and then we'll be cheeky and ask James and Andrew to stay on for a 5 more minute period, and maybe ask them one more question each before we tie up the webinar this evening.
Cool, yeah. So I think just to kind of reiterate what James does, which is so important, and as I said to you, he's dealt with it in a huge amount of detail in chapter 2. And then obviously what Andrew is saying in terms of what's happening logically in the markets around the world. What we basically decided, and I listened to Clem Santa for 5 years, and it was all about the scenarios of where the global economy was going and where the South African economy were going and what the probabilities were. And I thought to myself, well, it's all good and well to understand all this knowledge, but how do you put it into a practical tool? And so we built a system. We built the global property system. Effectively, again, we trademarked it, and I took it to Clem Santa, and I was very chuffed when he endorsed it, and actually gave us quite a remarkable comment that no one had actually taken his research and turned it into a simple, practical system so that people could make the right decisions. Now, again, we've got 3 chapters on this, where Clem Santa and I have written about it and how it actually works in the book, and so I'm not going to go into a huge amount of detail. But the bottom line is that based on just simple analytics, simple fundamentals, and simple economics, there's only one country at the moment which is sitting in the high return, low risk area. Australia is sitting in low return, low risk. The UK is kind of straddling between low risk and high risk, and then South Africa and a number of other countries are actually stuck in the low return, high risk quadrant. And interestingly enough, we've actually analyzed over 20 different countries, and for Egbert, that includes Nigeria, Thailand, Mozambique, you name them, Brazil, Cyprus, Ireland, Germany, and all the other countries that people constantly ask us about. But we've gone into a huge amount of in-depth analysis in terms of the UK, Australia, and America, which are the top 3 destinations we've been investing in. At a very simple level, I think the question a lot of people ask is, the rand has moved, and people know that there's been good options in property. But for me, it comes down to 2 very simple things. What is the value you're buying at? Is there intrinsic value? And when you look at a property like this, we bought it a year and a bit ago for $85,000. Today it's worth probably $125,000. I mean, that's a proper 4-bedroom American home, but we're still buying it between 40 and 60% below replacement value. So literally what it would cost to build that house out the ground today, we can still pick it up for between 40 to 60% replacement value. We're getting net yields, and this is just pure net yields after costs. No currency devaluation, nothing clever, no capital growth, pure net yields of between 8 to 13%. And we can actually get financing at 50%. And once you build a credit rating, you can actually get and fix your interest rates at 6%. So when you compare it to South Africa, just purely in terms of South Africa, it's better yields, better discounts, and really it's really attractive because you can get long-term financing fixed at 15 years. Again, if I compare that to London, it doesn't make sense because properties at full value and therefore much more susceptible to the economic shocks, and the net yield is somewhere 2, 3, maybe 4 to push. Here it's 8% plus, so it's more than double in terms of what I'm looking at. In terms of the research, again, I go into this in a huge amount of detail in the book, but the bottom line is The Economist researched the top 20 markets in the world, and they currently have America at 12% undervalued still in 2013, and they've got Australia and Britain are overvalued, and South Africa is sitting about neutral. I think what's really important, and again, this is the essence behind how we do what we do, but you've got the economic risk, which is pretty much what James and Andrew have been talking about tonight in terms of where the economy is going and also what is happening with regards to the currency. You've got the value of the property. I don't care whether you're buying a share, a property, or anything else for that matter. If you buy it at a discount, you've got a lot less risk than if you buy it at full value. You've got the fundamentals of property growth and supply and demand. And then one that a lot of South Africans seem to fail to understand the importance of is the rule of law. And that ultimately gives your risk index. And then in terms of your growth index, it's a combination of yield and capital growth. But we give a weighting of 70% to yield because at the end of the day, the biggest lesson we learned from the global financial crisis is those people that focus on yield, on income, and stuff that's sustainable and can happen are the ones that are able to get over the economic shocks, like Ryan mentioned. It's the guys that go after capital growth. It's like betting against winter. It does come, and they do end up in trouble and generally die. I mean, to give you an example, in the last 17 months, we've acquired 397 properties in the US to a value of nearly $30 million. We've had a capital growth on all those properties, depending on the different areas, of somewhere between 10 and 30% in US dollar terms. We've had net yields of anywhere from 8 to 15% in net dollar terms. We've done 6 buyers trips now, which is where people literally come over and invest with us. And on the last one, we actually bought 146 properties, and the last one being less than 2 months ago, where the IRR was over 20%. And I did a very interesting calculation, which actually shocked myself and quite a few other people. But including the rand devaluation, the investors that invested with us in the last 18 months have had an IRR at a minimum of 41% last year, which is actually astounding in terms of the big picture. But it's not going to be like that forever. America actually just 12 months ago was actually sitting at 19% undervalued. So remember, I told you it's 12%. So things change and markets change. But I think, just to give you an example of some of the results, a gentleman by the name of Gert bought a house, this one for $135,000. He's had a net yield of over 9%. He's had 25 to 30% capital growth. The rand since then has devalued 32%. He bought another one in Orlando and has subsequently invested a lot with us. In October, on one of our buyers trips, Ian and Raleen bought a property, this one behind them, for $95,000. They actually got more rent than they were expecting. They've had a growth of 36%. The rand has devalued 24%. And in February, they bought another 2 properties. And it's quite interesting. I've actually immigrated to Australia in July. And I said to them, why why did you do this? And they said, well, I want to choose to live wherever I want in the world, and I want my money to live in the place where I'm going to get the best results. I know Michael's online tonight, and Michael's a very interesting story because he came with us in February. A lot of people waited till March because the Americans were coming out, but he came in February, he took action, he invested then. He's had really good growth on the properties. The rand is devalued by nearly 25%. He's earned a net income on those properties. And really the results are quite astounding in terms of if you look at the rand return or profit that he's made. But I think the thing that's most interesting in terms of Michael is that also on top of that, we built a relationship. We managed to get him that credit rating, build the financing options. He got access to private financing. He was able to gear those properties and get another 3. And as we build that credit rating, we want to go to the traditional financing where, with time, we'd probably be able to get 14 or 15 properties for the same cost and the same sort of passive income without putting any more money in. And that's just an example of we're not in the game of helping people buy one-off properties. It's about building portfolios. It's about creating global wealth. And I think the results speak for themselves in terms of what people have done. But there's the other side. There's people that didn't come in February. They said, no, they'll wait for the extravaganza. And the rand, to be fair, didn't do a hell of a lot, but the property prices went up dramatically. Between February and March, they went up nearly 8% just in 1 month because of the big funds coming into the market. But that's another whole story. The extravaganza I already explained. James told people with a 90% probability what was going to happen. And 180 people did nothing. And within 6 weeks, the rand went over 10 rand to the dollar. We had one client that actually told me, and he's one of the most successful recognized people in property in South Africa, and he actually reserved a property, and then when push came to shove, the rand was 8.88, and he said, no, he'd spoken to his banker, and by the end of the year, the rand would be back at 8. I'm sure his banker is a little bit blue-faced, considering the rand was much closer to 10.50 by the end of the year. And we even had one client that put 4 million rand into Andrew's account, ready to go. She reserved 4 properties, put the money in, and then got cold feet and pulled out, and in less than 2 weeks lost over 500,000 rand. So, these are the consequences of inaction. And, I think the picture with someone putting their head in the sand is quite pertinent in terms of what we're doing. I'm not going to go into this in a huge amount of detail. I don't have time, to be honest. We've been trying to share too much. But what I do have is we've got an entire model, which I can actually share you. And I think, Ryan, if people can put in model if they want to, and I can send it to them. But what I looked at was the big decision everyone always asks is, do I do nothing and wait till the rand recovers? Which, James says it might, with a 20% probability, actually recover in the near term. Or do I just buy the intrinsic asset? I know what I'm getting the income, and I benefit from not only the income, but also the capital growth. And I looked at 5 scenarios. Do nothing and the rand recovers. Buy now and benefit from the capital growth, but the rand stays the same. Buy now and benefit from the capital growth and the income, but the rand actually improves back to best case. Would you have been better off if you'd waited a year, or would you be better off if you bought it today, even though the rand improved? Buy now and benefit from the capital growth, but the rand actually goes to worst case scenario, because James said 20% it goes good scenario, 80% it goes bad scenario. And that's just in the short term. Long term, it's 100% going, not really well for us. And then the 5th scenario was actually buying with leverage. And I think the important thing to show people here, and I've got all the maths and all the numbers and all the projections, and you can see the graphs there, but I think it's easier to see off the PowerPoint. And basically, the blue line at the bottom is leaving your money in the bank and your net wealth over the next 20 years. Your next 30 years, leaving your wealth in US dollar terms in the bank in South Africa. If you started out with about 1 million rand, which is what it would cost you to buy a house right now in America, you would have about $200,000 worth of net asset value. If you bought a South African property with an 8% yield and a 12% capital growth, which is the 30-year trends in South Africa, you would have about a $700,000 net asset value. If you bought the property and you waited a year and you waited for the rand to get back to best value, but you didn't benefit from the income that you would receive over the next 12 months, just the compound interest of that effect means that your net asset value would be just over $2 million. Whereas if you bought it now and benefited from the income and had the compound effect, you would be at nearly $2.3 million, another 10%. So people think, but if I wait, because the 20% of what James is saying, I'll be better off. It's not true. If you do your maths, the best case scenario is you're only 20% down. The worst case scenario is you're 50% down. And if you buy it on leverage, which we now have access to for all our clients, you'd be over $4 million. And I think that is dramatically important. There's a 1,600% difference. And if you go back to the Global Wealth Index, it's actually 2,300% the difference over the last 30 years in terms of our global wealth. And what's very interesting is the difference between a good South African asset and a good American asset is 439%. And people say, well, how do I offset what is happening in terms of all these long-term trends? And do you know that actually equates to owning 5.2 properties that are a first world asset with a first world income based on all the fundamentals and everything else we've shown? And if you just do that, you negate the effects of what we're talking about. So it looks hell of a difficult, but actually it's not that difficult, and that's why we do what we do. And at a simple level, we're launching this opportunity at our breakfast, but we're going to teach people how you can buy this house, and I'm sure you would agree it's a very stately home in one of the best suburbs in Atlanta. Atlanta's the fourth biggest city in America. It's the city that most South Africans choose to live in when they immigrate there. It's also the city that's been voted the #1 place in 2013 to live in America. And we're going to show people how they can invest here with as little as $30,000, roughly whatever that is, 330,000 Rand in terms of getting involved. And as you can see, it's extremely stately and what one can get. In terms of the prices, literally the prices have ranged between $36,000 to $145,000. And as I said, we can help people invest from literally $30,000. And you can see, it's as stately as any house that you live in here in South Africa, and certainly very much a plan B in terms of people wanting to actually live there. You can see the rolling estate, and we've only got a couple of opportunities, 23 to be exact, in that estate for the investors. For people that want existing property right now, we've got them. They're properties that we buy off the banks, they're repossessed. They generally, as I said, have replacements. They're below replacement, 40 to 60%. They've got net yields over 8%, and there is financing. And this was actually the gang in October last year on the buyer's trip. But if you're interested, just type in consultant, and the consultants can take you through this. And then for those of you who want to be more sophisticated, we're also doing, the commercial stuff. We're buying commercial opportunities. We've got some fantastic partners on the ground in both Australia and in America, and we're doing a number of commercial opportunities as well, in terms of what people want. And just in our interest, we've got a buyer's trip, which is coming up in March. It's March the 18th to the 28th of March. And, there are only a couple of places left. We are keeping it very exclusive. And the reason for coming really is that you get the right information on the ground. You meet the right partners. It's all about the information of the partners. Andrew can attest that. He was on our trip in October and actually coming and shaking the people's hand and understanding it. You get to learn and engage with other sophisticated investors. I think I stand to be corrected, Andrew, you actually met someone you'd never met before and are now actually, doing business together, you and Pedro. You became good friends and had lots of fun together as well.
Yeah, as I said earlier, when people are faced with a crisis, they change their behavior and you bond well. But it was a great trip. I personally have quite a lot of interest in property, so I tied the trip in with a business trip that I had to go on for our business, and I must say that having listened to Scott and partnering with him in South Africa for a long time, it was nice for me to actually see the reality of everything that is presented. And they've got a great team. They've got good lawyers, buyers, they've got good relationships with the banks. So yeah, it was very interesting.
And
take some pro hips along.
Andrew, I can't work that hard without having some fun. But we're all very busy, and time is our most valuable asset. But it does cost to fly over there. But for someone like yourself who's a serious investor, is it worth going over? Would you recommend it for people?
Well, I think that you get two types of people. I'm amazed that we see a lot of people buying property sight unseen. I'm the sort of person who likes to see what I'm buying and understand the sort of the macro environment in which it sits. And I think it's if you can afford the time relative to the long-term investment, it's actually it's really worth doing. And you can make a little bit of a holiday of it if you can. But yeah, I think it's good to go and feel it and see it.
And I mean, I use Michael as an example. I'll never forget back in February last year. It was the first week in February, and everyone had excuses, and it's too soon in the year, and I'm trying to get my business going, and that's why I like to show results like what Michael's achieved in the last 12 months, because he was, he had the tenacity to make it happen no matter what, and he got rid of the excuses and got the results, So, but yeah, I mean, just an example as well. We are unlocking a new area in Dallas, which is really exciting. We've got the same financing partners. We've got the same management partners, some of the best in the country. John Chin is doing all our investigation there. So, very trusted, respected partner. So you can come with us and unlock a new area, which will be good. And then, you can take action and have fun, which I think, which is always pertinent. A lot of people get frustrated. They go over and they come back with no results. And we allow people to actually get those results. So, a lot of questions are coming through, but I think just to finish off, for those people that want to go, and then we will answer some more questions. But the most important thing is to speak to an asset manager. Just type in consultation or type in asset manager. If you've got questions, whether it's about the RAND, if you want to talk to James, I know people typed in James earlier. You can type James. If you want to talk to Andrew in terms of setting up an account and moving money and getting your tax clearance, type Andrew, and he'll be able to facilitate. But the most important person that brings it together for you are asset managers, because they can understand what it is you're trying to achieve, and then they can point you in the direction in terms of the solutions, So that really, really is absolutely critical. Come to one of our USA investor breakfasts. They're now at the end of February. They're at the 24th of Feb in Cape Town, 25th of Feb in Durban, 26th of Feb in Pretoria, and 27th of Feb in Joburg. You get to meet other like-minded opportunities. We are launching that exclusive opportunity just to the IPS clients, and it'll only be available at that breakfast. And also we'll be talking more about Dallas and what we're doing. So we've got a lot of stuff that is really, really good. And what we'll also be doing is we'll be sharing with people how they can get a copy of the book for free. Property Going Global. The website is up. We will be sending you an email with a link to the website. You can buy it in hardcover. It is currently going into the bookstores. But as I said, the people that come to the breakfast will actually be able to get a copy of that for free. And we will share with you how to do that. But Property Going Global, the website propertygoingglobal.com is currently literally should go live as of today in terms of what Brendan's doing. And we all ready now to take it in terms of the mainstream. A lot of the stuff we've spoken about tonight is in a huge amount of detail in that book, and that's thanks to Andrew and James in terms of where they're at. Now, Ryan, I know you had a lot of questions, and we will send out an email to follow up in terms of a lot of the calls to action that we said, like the link for people to be able to click on to be able to book for the events. There's only limited seats at the breakfasts, and people can book and come along. We don't make any money. That people just pay for the breakfast, the actual physical breakfast that they're going to eat, and we'll also send a link, for the book in terms of how they can get access to it. But I mean, I know there's quite a few other questions here. James and Andrew, would you mind just like answering one or two more? I know it's late and we've gone well over our time, and for those people that need to sign off, they can. But for a few others, would you like to answer a few more? Do you mind?
I'm very happy to, Scott.
Sure, Scott.
I've got a doozy for James here, and I know Peter's asked this question, and I've been on the fence as to whether I should pin you down here, James. So you ready, my friend? Have you got your seatbelt on?
Go right ahead.
And I think it's a great question, because we made reference to the RAND in the long term going to in the region of 14 to 20. And Peter's commentary is, that's quite a broad range. Is there any way you can be more specific in terms of timelines and all that kind of stuff? And is it even worth doing that? Because aren't we just simply looking at the long-term trend from that perspective? So what's your point of view on that question?
Yeah, it does depend on how the patterns play out, but I'd say looking at over 14 in the next 5 years, and probably closer to 20 in the next 10.
Oh, excellent.
And I think a good question that Peter asked as well, in terms of where to put his currency and stuff. I think, Peter, what we'll do is we'll put you in contact with Andrew, and you guys can sit down at a sophisticated level, and kind of he would need to understand better, what are you trying to achieve, and then ultimately be able to give you that type of guidance. But in terms of the technicalities of it, because again, obviously tonight is trying to give people an overview in terms of your personal requirements. That's what it is about meeting with one of ourselves or one of our asset managers, so that we can actually help you in a unique way. None of us are salesmen, none of us are estate agents, none of us are here to sell you product. What we're here to do is understand what you're looking to achieve and then help you with a solution. Ryan, have you got another question there?
Excellent. Yeah, we've got. I'm going to try and get. I'm trying to pin Andrew down from a different perspective. Andrew, have you got your seatbelt on, mate?
Yep, always.
I'll make it vague, which is probably it's going to be the complex part of it. In summary, we've covered a lot of the fundamentals. We've covered technical side. We've covered your experience from a global perspective and also from a fundamental perspective. What would you say in summary people should be looking at? Not from an advice perspective, because we don't want to give people advice, but what would you say the general sentiment is?
Look, I think one of the things, it's a hard time now to be making a decision because we've come off a recently strong rand. I mean, in the last 2 years, we've seen a very big drop. So it's still quite fresh in our minds how good the rand can be, and we're suddenly seeing foreigners leaping into SA and finding it very cheap again. But as everyone said, waiting and waiting costs you money. It's not only about the rand. I think the really important thing is that if you are looking to make any sort of offshore investment, explore these opportunities where properties are severely discounted to replacement value. I don't think Scott was even talking about discounting to what they sold at the top of the market. But if you had to go and build a brand new house, you're going to come out more expensive than you can pick up a completed house with a tenant in it. So just make sure, my advice is just make sure that the underlying asset is good, and take the emotion out of the rand at the time when you make the investment, because we see it on a daily basis. We do hundreds of deals every day, and I can hear my brokers on the phone chatting to clients, and they're kind of like, it's a sorrowful discussion, because you can just hear the guys are in pain, and it's like, we can't advise you exactly when it's going to strengthen this week or not. I mean, nobody can. It's subject to so many unpredictable forces. But the medium to long term trend is, there's no doubt that you've got to look at hedging. If you're happy living in SA and just keeping all your wealth here, then you make that decision, but you're going to lock yourself in here for a long time, and it just makes those overseas trips and everything a lot more uncomfortable. So yeah, if it just goes down to understand the asset class and make sure it's a good investment in its own environment.
Brilliant, thanks.
Ryan, can I ask a question?
Much like sports.
Can I ask a quick question,
Okay,
which I'm interested for either James or Andrew to answer? But the election coming up in May, May the 7th, what do you see in terms of the impact of that having on the rand?
James, do you want to go first?
I can.
As a technical man.
Yeah, well, the technicals, that the market is sentiment, as we showed there, and the fact is, for the last 3 years we've been on a negative sentiment, and we've got that is overdone and due for some correction. But the election could be a trigger for that correction to be complete and for the next move up. I can't really say. It depends on what the actual global sentiment is at that point in time. When I say global sentiment, the sentiment towards this country.
Yeah, I think it's a very difficult. Yeah, that's a very difficult question to answer, because I think that in the last couple of years, I think a lot of the internal wranglings with the ANC and their conferences and things have had quite a lot of negative effect. We might be pleasantly surprised at this election if the ANC's majority reduces. That may well be viewed quite positively. There may be a change in quite a lot of the leadership. Who knows? But I mean, it's very difficult to predict. I mean, 2 weeks ago we thought Zilla and Rampela were getting together, and a week later they weren't. So I think it's really, it could go either way. But I think long term it's not going to make any difference. My opinion.
And Scott, as they do on these super sport panels, where they try and get you to predict a score, what would you say moving forward? Your best advice to everyone listening?
The best advice that I've got from some of the wealthiest people that I invest in is twofold. The one is always focus on income. So even when my London properties lost 15 or 20% because people got so scared as Lehman Brothers happened, and to be fair, I was equally quite concerned. But very quickly I realized that if you've got a good property in a good area, and there's an income demand, whether it's residential, commercial is irrelevant. It's the quality of the income demand that you can rely on. Then you can weather any storm. If you go after capital growth, as I said to you, it's like betting against winter, and it's only a matter of time. And that we've witnessed from the smallest property people in this country that tried to have double trust structures and other clever techniques to enhance capital growth, to the biggest funds internationally, and effectively all the business models collapsed. But the wealthiest guys that I deal with that focused on income actually got stronger when the market went down. So that for me is absolutely a fundamental in terms of income that one focuses on. And the second one is a common thing, from Warren Buffett to any other investor, to Clem Sunter. Clem Sunter's advice he's given in the book and in the webinars is it's about diversification. Anyone that tries to put all their assets, all their income in any one currency, any one asset class, or any one country is naive. It just doesn't work like that anymore in the 21st century. And, like I say to people, in Wealth Migrate, we talk a lot about nature and how, the birds, the buck, the animals, even the fish, migrate from one environment to the next so that they can take advantage and adapt no matter what happens. And, I always say the birds that fly from north to south when winter comes don't, have a saying, fair fun my skutna and my skada, and they say, I'm going to sit here in winter and freeze to death no matter what happens. It's about being able to adapt and having the diversification. And really with where the world's going, and with experts like James and Andrew and our team, being able to advise people and looking at it from a scientific system and not a gut feel and not what your mate says, or to be honest, even what your banker says, then it allows you to build your global wealth. And if you do that, you create freedom. So, if you focus on income and diversification, then you will be able to create global wealth. And if you create global wealth, you've got freedom, which, to be fair, every single person wants. Freedom just means different things to different people.
Okay, thanks. Thanks, everybody. We've, as traditionally with IPS webinars, we've gone severely over time. At least we're consistent, hey, Scott. But I think, I think a lot of people have stayed on. We've still got over 70% of people online. In fact, it's probably 80%. And it just goes to show just how interesting this topic is, and how important it is to our everyday lives, and also the lives of our children and their children moving forward. Certainly be incredibly enlightening for myself. And I'm sure we could be going on for another couple of hours with the really long list of questions we've got here. So if we didn't answer your question specifically or come close to answering a question, I apologize. But we will have opportunities to talk to you on an individual basis. So if you would like to speak to an asset manager, particularly around investing offshore, then please type in asset manager and we'll get those people to call you directly. We've just got a gentleman who made a comment and said he attended the webinar specifically to understand the currency because he is an international businessman and he's become particularly interested now in investing in property. What should he do next? That's really simple, Mark. what you need to do there is just type in asset manager, and one of our asset managers will give you a call to understand what you're looking to achieve and give you some options to investing. And I've seen a few people also say that the opportunities we're presenting are including only residential property. That's not actually true. Historically, IPS has been a residential investment company only. However, we do have Wealth Migrate, where there are some fantastic commercial and development opportunities as well. So,
and also on top of that, Ryan, we have some of the most sophisticated partners, in the first world countries that are investing, with us jointly, including, as an example, Grant Thornton. So, some of the biggest branded people, and in terms of their experience and track record, so that we can take advantage of both residential and commercial in both the UK, Australia, and in America.
Yeah, well, I think what we'll do next time, Scott, is maybe introduce a couple of those opportunities as well, because historically IPS have been known as a residential-only company, and in fact IPS is, but we do have that Wealth Migrate arm where we have some big players involved doing some fantastic opportunities at some really great returns. So if that's of interest to you, I know Paul I'm looking at, and a couple of other people asked me that question, type in Wealth Migrate, and we can actually talk to you specifically about that. We'll get a Wealth Migrate specialist or Scott or Brendan on board to talk to you as well. So the bottom line is, don't get too hung up on what type of opportunities are relevant to you now. All you need to know is if you are interested in investing offshore, then we can have a chat with you, because I can assure you there's a lot more opportunities on this available through us. And I think maybe what we'll do, Scott, in the very near future is just do a webinar dedicated to the types of opportunities we've got available, because we're getting a lot of demand for that. So that's perhaps something we can look at doing in the future. So thanks, everybody. I don't know if, Scott, you want to finish up and wrap up, but I just want to say on behalf of myself and the IPS team, thanks, Andrew, thanks, James, thanks, Scott, for being online, and thanks, everybody, for being online this evening. And I'll hand over to Scott to close up.
Perfect. Thanks, Andrew and James, thanks as always. It takes a huge amount of preparation. I think people underestimate how much time and effort is put into, running it, and having 4 people talking at the same time when they're all sitting in 4 different parts of the country is also fairly tricky. So thank you to all of you for being online, and to everyone that joined us as well. There was awesome energy. There were really an amazing turnout tonight, and a huge amount of very intelligent questions. So I know from James's perspective, Andrew's perspective, Ryan, and my perspective, the intelligence questions are what makes it exciting, because otherwise it gets a bit boring. I don't know how you feel about that, James and Andrew, but certainly I've enjoyed everyone's questions a lot.
Yeah, no, it's been good. Yeah, definitely stimulating, and hopefully we've opened some thought patterns for people.
James, from your side?
Yeah, same here, Scott. Just trust we provided the value that we hope to.
Cool. And as I said, we will be passing on James and Andrew's details, and our asset managers have all those details and can help you as well. I want to leave you with a story, because I think people understand it probably better than anything. And, a lot of people can get caught up in analysis paralysis and trying to understand James's graphs. And trust me, if you didn't understand them, it took me about 5 years. And, trying to understand what Andrew's actually saying and what impact it's going to have in relation to what your brother said at the dining room table on Sunday afternoon. But at the end of the day, my uncle back in 1980, at the age of 30, decided that he lived in Africa. He loved living in Africa. Like you said, Andrew, I mean, all of us, funny enough, well, Ryan, myself, and Andrew all lived in England I was 9 years, Ryan was 12, and Andrew, I think, was 10. And we all came home. We all choose to live in South Africa. We love it here. So it's not about whether we like South Africa or not. We're passionate about South Africa. And my uncle was the same. But at the age of 30, he decided to have a plan B, to diversify. And all it took was making that decision. And ultimately, he accumulated his wealth both in emerging markets in Africa and in first world markets, in terms of first world assets and first world incomes. And unfortunately, we all know what happened with Zimbabwe. And in 2003, it had nothing to do with finances. It had to do with his son, who was 7 years old, and the teacher had left, and the dentist, there were no dentists left in Harare. And to be honest, at no point am I saying South Africa is going like this. But my point being is that when he wanted to make a decision, he was not forced to make any decision. He could choose to do whatever he wanted. And he chose that he would like to go and live in Australia. He bought his way into Australia at the age of 53, which for those of you who don't know, after 45 is very difficult. He put his kid through a private school, one of the best in Australia. He bought a house, a very expensive house in a very good area in Brisbane, cash. And what I believe most importantly is that he didn't have to work for an Australian, as in, he had set himself up and he had the freedom. And why that story is so important to me and why I'm so passionate about it, and I know, Ryan and the rest of the IPS and Wealth Migrate team are, and, I'm sure Andrew and James have had a lot of perspective in terms of the global stuff, is that if you're naive and you bury your head in the sand, then no matter what happens in the future, you're susceptible to things that are going to happen. You are basically reacting. And you've got a choice in life, and it's a very simple choice. You can either react or you can be proactive. And like my uncle, all it takes is making a decision. And if you make that decision and you plan for different scenarios, then you will be able to have the freedom to make whatever decisions you want, no matter where you want to live, no matter what house you want to live in, no matter what school you want to send your kid to, university, where you want to go on holiday, who you want to give your money to, whether it's the church or some charity. It's irrelevant. Everyone's different. But it's that freedom that we're talking about. And so don't underestimate the value of it. And hopefully my uncle's story highlights how important this is to everyone. And that's why we all work so hard to bring people like Andrew and James to you and to be able to share their knowledge. So I want to thank all of you. I want to thank James and Andrew specifically. Thanks for your time. And most of all, please go out there as proud South Africans with a smile on your face. Now you have the facts. You get to decide what you want to do with it. Thank you and good night from all of us.